My name is Farhan. Today we are going to prepare an income statement and a statement of financial position. This question is taken from 2023 Paper 2 exam. Bev plans to start trading as a sole trader on 1 January 2024 as a wholesaler of ceramic plant pots. She needs to prepare budgeted financial statements and has provided the following estimated financial information. So here you can see we are given 10 additional information that we need to incorporate in our workings when we are preparing the budgeted income statement for the year ended 31 December 2024 and also a budgeted statement of financial position at 31 December 2024. So we understand based on the first paragraph, Bev plans to start trading as a sole trader on 1 Jan 2024. So given that we are required to prepare the financial statements for the year ended 31 December 2024, we understand that only 1 year has passed so far. So on the right hand side, you can get to see all the workings that I've done. So I'm going to start with the first additional information. Revenue for the year is expected to be £60,000. All sales will be made on credit, and trade receivables are expected to pay their accounts 1 month after the sale is made. If you check additional information number 3, it says that revenue and purchases are expected to occur equally across the year. Now, what we understand by this is revenue per month can be calculated by taking the annual revenue of £60,000 and then dividing it with 12 based on what's given in additional information number 3, which says that revenue is evenly distributed across the year, which means if the revenue for the entire year is £60,000, then for revenue on a monthly basis would be £60,000 divided by 12, which is £5,000. We also understand that trade receivables are expected to pay their accounts 1 month after the sale is made, which means for the year ended 31 December 2024, we are collecting the cash from our credit customers for 11 months of sale. But for the last month of sale, which is December 2024, that will be collected in the following year in January 2025. Therefore, the trade receivables in this case is only going to be the balance for 1 month, which is £5,000. Trade receivables are also known as the credit customers of the business, who are the current assets of the business. So we need to include this amount for trade receivables of £5,000 as current assets in the statement of financial position. So I've mentioned that here. So make sure to make a note of all this. Let's start with the second one. So purchases for the year are expected to be £24,000. All purchases will be made on credit, and trade payables are expected to be paid 1 month after the purchase is made. So given that we know that purchases are also expected to occur evenly across the year, we can find the monthly purchases by taking the annual purchases of £24,000 and then dividing it with 12, which gives the monthly purchases as £2,000. We also understand that trade payables are expected to be paid 1 month after the purchase is made. So, similar treatment to what we have done for revenue and trade receivables, we will be paying our credit suppliers for 11 months, but we will be paying for December in the next financial year in January 2025. Therefore, at end of 31 December 2024, as a business, we have an obligation towards our credit suppliers or our trade payables, and that is £2,000, which is classified as a current liability and therefore will be included in the statement of financial position. So you can see again, I've made that note here. So trade payables of £2,000, which are treated as a current liability. And we understand that current liabilities go in the statement of financial position, and that is where we are going to record this. What about the next few information that we have? Starting with point number 4, it says that closing inventory is expected to have a value of £3,800. All right. So closing inventory is recorded in two different places. It is recorded in the calculation for cost of goods sold in the income statement and also as a current asset in the balance sheet, which is the statement of financial position. So I've made that note here, closing inventory of £3,800. You need to make sure that you are including it in the cost of goods sold or the cost of sales section within the income statement and also as a current asset in the balance sheet. So why is this a current asset though? Now, closing inventory has some economic benefit. How is it an economic benefit? So when the business sells these goods, let's say the next financial year, they're able to get cash, which is also including some profits because the business is going to cover their costs and make a profit by selling this inventory. So that is why the economic benefit attached to this inventory is what defines it as a current asset and therefore is included in the statement of financial position. Okay, so point number 5. Rent for the warehouse is expected to be £1,300 per month and will be paid 1 month in arrears. So we have 12 months in the financial year starting 1 Jan 2024 and ending 31 December 2024. So we understand that rent on a monthly basis is £1,300, which means for the entire year, the rent expense should be £1,300 multiplied by 12, which gives us £15,600. We also understand that rent is paid 1 month in arrears, which means we have paid all the rent for January, February, March, April, May, June, July, August, September, October, and November. But for the month of December 2024, this is something that we owe, and we will be paying in January 2025, which means when we are preparing the financial statements for the year ended 31 December 2024, we have total rent expense of £15,600, which covers all the 12 months. And this is based on the accrual basis of the accounting concept. But we understand that we have rent payable of 1 month, which is £1,300, which is also known as the accrued rent, as you can see here. And that is to be included as a current liability in the statement of financial position. So I'm going to make this note here as well. So accrued rent or rent payable, they're just synonyms of each other, is £1,300, which refers to the 1 month of rent the business owes at 31 December 2024. This is treated as a current liability, and we need to show this within the statement of financial position under the current liabilities section. Okay, so point number 6 is pretty easy. It says that other costs per year are expected to be administration and marketing £2,400 and wages of £18,700. All right, so I've just made a note here. So both of these have to be treated as expenses, both administration and marketing and wages. Point number 7 has to do with purchase of non-current assets. So Bev will purchase a delivery van for £12,000. She will depreciate the van on a reducing balance basis at 30% per year. She will also purchase some equipment for the warehouse for £9,800, and she will depreciate the equipment on a straight line basis for 4 years. The equipment is expected to have a scrap value of £1,800. A 4 years depreciation will be charged in the year of purchase for all assets. Okay, so we have 2 types of assets here. Both are non-current assets. So the first one is the delivery van, and the second one is the equipment. So we're going to start with the delivery van first. So based on the information that's given to us, we understand that the cost of the delivery van is £12,000. The depreciation method for the delivery van is reducing balance basis at 30% per year. Now, although we are using the reducing balance basis in this case, in the first year of usage, we can just simply apply the percentage on the cost. So we have done 30% simply multiplied on £12,000 because the business is in the first year of its operations and the delivery van is in the first year of its usage. So which gives us the depreciation of delivery van to be £3,600. Now, if we were in a second year under the reducing balance basis, you would have applied this percentage not on the original cost, but on the net book value. So this is something that I'll be showing in a different video, which you can subscribe and like this video so you can get notified. Okay. So the depreciation of the delivery van is 30% simply multiplied on the cost of 12,000, and we should get £3,600. Now, what about equipment, which is the second asset? So we purchased the equipment at a cost of £9,800, as you can see here. And we understand that the equipment is to be depreciated on a straight line basis for 4 years. And the equipment has a scrap value of £1,800. Now, scrap value is also known as the residual value or the salvage value. Now, what does this mean? Scrap value means the amount that you can sell your asset for after the end of its useful life, which means after the equipment was fully used for 4 years, if we were to sell that equipment, we could sell it for £1,800 after 4 years. So that is the meaning of scrap value simply. We understand the method for depreciating the equipment is a straight line basis. So we find the depreciation by using the formula, which is cost minus scrap value divided by useful life. So the cost is given as £9,800, the scrap value being £1,800. And then we divide with the useful life of 4 years, which gives the depreciation expense for equipment to be £2,000 per annum. Okay, so point number 8. Bev will invest £7,200 capital from her own savings and expects to make drawings of £1,600 across the year. Right, so this business will be started with Bev's money, which is the initial capital of £7,200, which is also known as the opening capital. We understand that during the year, Bev is going to make £1,600 of drawings. So if there are drawings that are made, that should reduce the owner's equity or the amount of capital that is available for reinvestment purposes in the business. So that's the note I have mentioned here. So the drawings that we are going to have, that should reduce the owner's equity or the owner's capital that are available for reinvestment. Now, point number 9, a 6% bank loan for £15,000 over 5 years will be taken out on 1 Jan 2024. Monthly repayments will be made across the period of the loan. Interest will be charged on the balance outstanding at the start of the year. Now, I need you to be very focused and understand this. We have a few complications here. Now, interest expense per annum can be calculated by taking the annualized rate of 6%, which is given to us, and multiplying it on the loan principal of £15,000. So the £15,000 here refer to the amount that we have borrowed. And on that basis, we get an interest expense of £900. We understand that interest expense is the cost of financing, and this is what needs to be included in the income statement for the purpose of calculating the profit accurately. Now, the loan that we have taken from the bank at an interest rate of 5% is to be repaid in 5 years, as you can see here, which defines this loan as a non-current liability. Okay? We understand that we are making monthly loan repayments, and those loan repayments will be made evenly or equally, which can be calculated by taking the total amount that we have borrowed, which is £15,000, and then dividing it with 60 months. Where did we get 60 months from? 5 years is 60 months. 1 year is 12 months. So 5 years makes it 60 months. So £15,000 divided by 60 months gives it £250 per month as the monthly loan repayment, which means in the financial year, which is the first year of operations for Bev's business, starting 1 Jan 2024 and ending 31 December 2024, the total repayment would be £250 on a monthly basis multiplied by 12, which makes it £3,000 as the total repayment made towards the loan in the first year of operations. Now, after that repayment has been done, the amount of loan that would be due at 31 December 2024, which is the end of the financial year, is 15,000 minus 3,000, which is £12,000. Now, there's one more thing I need you to understand here. Now, £12,000 is what Bev owes at 31 December 2024. And that is the first year that has entirely gone for the business operations. Now, this loan has 4 more years, and we will be paying the loan evenly across the 4 years. So 12,000 needs to be divided into a non-current liability and a current liability. We understand that in 1 year, the total loan repayment we can make is £3,000, given that we pay 250 per month, and in a year we have 12 months, which makes it £3,000 as repayment in 1 year. So the £12,000 that is available at 31 December 2024, we understand that £3,000 will be paid in the financial year of 2025, which defines this 3,000 as a current liability or short-term borrowings that we have to repay, because this 3,000 will be repaid across the 12 months starting 1 Jan 2025 and ending 31 December 2025. So this fits the definition of a current liability, and current liabilities are simply those liabilities which we have to pay in the next financial year. So the remainder of 9,000 refers to the non-current liability that would be remaining, given that we are today at 31 December 2024. And from this perspective, at 31 December 2024, the non-current liability portion would be for year 3, year 4, and year 5, which is 2026, 27, and 28, which is £9,000. And the £3,000, which needs to be the current liability, relates to the entire payments made across 2025, which is just the next financial year. So that is why we define this as the current liability. So when you prepare a balance sheet, the statement of financial position, if you show this clearly, 9,000 as non-current liability and 3,000 as current liability, you'll get the full marks there. Okay, so now that we have all the calculations sorted, we can simply prepare the income statement now. So I've got the income statement prepared in advance, and it's very straightforward, nothing rocket science here. So we're going to start with revenue. So revenue is for 12 months of £60,000, because beware in mind that the income statement is for the entire year ended 31 December 2024. And we know revenue on an annualized basis is £60,000. Then we subtract the cost of goods sold. Now, the cost of goods sold can be calculated by starting with the opening inventory, which is zero. And why is this zero? Because we are in the first year of operations, and in the first year of operations, we didn't really have any opening inventory to begin with. So after the opening inventory, we add purchases to the amount of opening inventory, which is £24,000 for the entire year, that you will see in additional information number 2. And then we are subtracting closing inventory of £3,800. Now, closing inventory of £3,800 is what we had in point number 4, and we figured out that this needs to be included within the cost of goods sold or cost of sales section in the income statement, and also as a current asset in the balance sheet. So make sure you remember that when we prepare the balance sheet or the statement of financial position, we need to show this closing inventory again. So you subtract the closing inventory from the purchases and the opening inventory, you get £20,200 in total. You see, I've kept this in brackets to reflect that we are subtracting the total of cost of goods sold from the value of inventory. So we subtract cost of goods sold from inventory and we get gross profit of £39,800. Then we are taking all the expenses that we have and subtracting them from the gross profit. So we are starting with rent expense of £15,600 based on our calculations that we have done here. We also have wages of £18,700 and admin and marketing of £2,400. So this is what was given to us in point number 6. Administration and marketing of £2,400 and wages of £18,700. Then we are including depreciation for VAT, which is what we have calculated ourselves using 30% under the reducing balance method. But we understand that the delivery van is in its first year of usage. So although it's a reducing balance method, we can simply apply the percentage on the total cost. So 30% multiplied on £12,000 gave us £3,600 as the depreciation expense for the delivery van, which is what we have included here. Then we have included the depreciation expense for the equipment, which we have calculated using the straight line method, and that is £2,000. Then we had included our interest expense of £900, which was calculated by multiplying 6% with the loan of 15,000 that we have taken. And that's it for all the expenses. Excuse me. So what we are doing now is find the total for all the expenses, which gives us £43,200. So we subtract the total for all these expenses from the gross profit of £39,800, and we get a loss of 3,400. So you need to be very specific when you write this. You need to write loss for the year of 3,400 in order to get the full marks for this part of the question. Now we are going to look into the balance sheet. So let's prepare the balance sheet or the statement of financial position as at 31 December 2024. So I have already prepared the outline here in advance, and we are going to start with the non-current assets. So the two non-current assets that we have in point number 7 was where the delivery van and the equipment. So we understand the delivery van had a cost of 12,000 and the equipment had a cost of 9,800. In terms of the total depreciation, we only have 1 year of usage for both of these assets, and we understand that a full year's depreciation is done for both of these type of assets. So we have 3,600 for delivery van and 2,000 for equipment. We are subtracting this. That's why we are keeping this in brackets. So once the depreciation is subtracted from the cost, you get the net book value of 8,400 for delivery van and 7,800 for equipment. Okay, so the next thing we have are the current assets. Now, in terms of the current assets, we have trade receivables of £5,000 from the first information that we had, as you can see here. So trade receivables of £5,000. And then we have closing inventory of £3,800. So closing inventory is a current asset based on the discussion we had earlier about the economic benefits that we expect to achieve in the next financial year by selling this inventory. So closing inventory is also included here. We do not really have any other current assets, but be sure to be mindful in exam and check whether or not you have any other current assets that you have left behind. For example, you could think about prepaid expenses, such as prepaid rent, which refers to rent payment made in advance. So in this case, since we do not have any other current assets, we are just finding the total straight away. So total current assets, 8,800, which is added to the net book value for the total of non-current assets, and that gives us total assets of £25,000. Then we are showing the capital section. And for the capital section, we are starting with opening capital of £7,200. So you can find this information in, let me show you. So you can find this information in point number 8. Bev will invest 7,200 as capital from her own savings and expects to make drawings of £1,600 across the year. So that is the opening capital we have included here of £7,200. Then normally with opening capital, we should add profit. Now, profit increases the capital available for reinvestment purposes. Even though you make a loss, that decreases the capital available for reinvestment purposes next year. So with the opening capital, you're also adding the loss. But when I say you're adding the loss, it's already a loss. So it's going to decrease the capital that is available. So we're putting it in brackets to reflect the fact that we have made a loss. So if we had made a profit, you would have added that without the brackets, which reflects the increment in the total capital available for reinvestment purposes. So on that basis, we get 7,200 minus 3,400, which is 3,800 as the capital available for reinvestment. Then we subtract drawings, which further reduces the owner's capital or the owner's equity that is available for reinvesting in the next financial year. And the drawings is given as £1,600 in point number 7. So once you subtract the drawings, we get the closing capital of £2,200. So that is what is available for reinvestment in 2025. Now, after the capital section is done, then we have the liabilities section to take care of. Now, before I go into the liability section, I want to ask you something. If you understand how the balance sheet or the statement of financial uh, position is prepared, what is the accounting equation? Now, the accounting equation is assets equal to the total of capital plus liabilities. So basically, if your business was to be, if your books for the business was to be done correctly, if the financials were to be done correctly, a way to check if they were prepared correctly is to check that whether or not all the assets in the business, which are the total assets, equal to the total of capital and liabilities. So we have understood capital so far. So we are going to look into liabilities. So we have non-current liabilities of the loan of 9,000, and we had a long discussion a while ago. Why is this 9,000? I'll just quickly recap. So we understand that in 1 year, we have to pay a total of £3,000 as loan repayment, which means in the first year, after £3,000 have been paid, the loan that would still be due at 31 December 2024 is going to be £12,000. But then again, in the next financial year of 2025, we have to pay £3,000 again, which fits the definition of a current liability or an obligation that is to be paid in the next 12 months. So if we separate that 3,000 from the 12,000 here, then the 9,000 that is left behind is the balance that we have to pay in 2026, 27, 28, which are not in the next 12 months, but after the next 12 months, and therefore fits the definition of a non-current liability. So that is why when preparing the statement of financial position under non-current liabilities, we are showing loan as 9,000, which reflects the long-term obligations. But when it comes to preparing the current liabilities, I'm showing short-term loan of 3,000 here, which refers to an obligation that is to be repaid very soon. Now, this is important for investors to know because it gives a clear idea of the business's cash flow requirements in the next financial year. So that helps these investors or new potential shareholders to make better decisions or informed decisions. Now, so for the current liabilities section, so we have the bank of 7,500. So this is the balance that we had to calculate ourselves based on the requirement here, using the bank balance as a balancing figure. So I'll come back to this at the end, but I'm just going to circle this now. So we have trade payables of £2,000 based on the purchases and the payment for purchases that are made on a 1 month credit basis, which in this case is £2,000. Rent accrued is £1,300 for the last month of December that we will be paying in Jan 2025. Therefore, this is an obligation, a short-term obligation to be paid off in the next financial year. And then we already have the discussion for short-term loan. So we understand that this statement of financial position or balance sheet has to balance. And based on the accounting equation, we understand that assets must equal to the total of capital plus liabilities. Based on our first section, we found the total assets of 25,000, and then we found the total capital to be £2,200 based on what you can see here as the closing capital. So £2,200. So how much does the liability have to be in total to make it 25,000 in total when added to capital? So it's just simply the difference between 25,000 and 2,200, which is 22,800. So this 22,800 here has to be the total of liabilities. So non-current liabilities take 9,000, okay, which means current liabilities must take 13,800. So when these two are added together, then the total comes out to be 22,800. Okay, so we have just simply used algebra to find the missing value here for bank. And I'm going to show you the calculation here in case you're still confused. So let me show it to you. So I'm going to prepare the equation here again. So assets equal to capital plus liabilities. So total of assets equal to total of capital plus total of liabilities. So we understand total assets are 25,000, total capital are 2,200, which means liabilities must be the difference between 25,000 and 2,200, and that is 22,800. Okay, so total liabilities are 22,800. Now, total liabilities can be calculated by adding the non-current liability, which is NCL for short, and the current liability, which is CL for short, and that should give you 22,800. So the only non-current liability that we had is the loan, so which is what I'm including here as 9,000. And for the current liability, just forget the bank for now. So bank is what we have to find as the balancing figure based on the requirements of the question. And we just simply add the other three, which is trade payables, rent accrued, and the short-term loan. So trade payables are 2,000, rent accrued are 1,300, and short-term loan are 3,000. And all this added together. Okay, so we also need to include bank here, plus bank. All this together should give me 22,800 pounds. Okay, now before we go further, you might have a question like, why is it that bank is shown under the current liabilities section and not as a current asset? It's because of the requirements of the question. So if you check the point number 10, it says that the bank has also agreed an overdraft facility of £5,000. So this is pointing towards something in terms of bank being an overdraft where it's more of a current liability and not a current asset. And the requirement of the question is to use the balancing figure for bank to ensure the math is fully balanced from total assets and capital liabilities perspective. So the only thing where the bank fits in this case is therefore under the current liabilities section. So the non-current liabilities here are 9,000. Current liabilities in this case are the total of trade payables, rent accrued, short-term loan, and bank added together, which is the overdraft. And all this together should give me 22,800. So let's simplify the calculations. So I'm going to add all the numbers in this equation together. So 9,000 plus 2,000 plus 1,300 plus 3,000 is 15,300 plus bank should give me 22,800. So we are just doing algebra here. So if you want to find the balance for bank that is applicable in this case is 22,800 minus 15,300, which should give me 7,500. And that is where this balancing figure comes from. So this fits the definition of a current liability being a bank overdraft, which means the business has no money in their bank account and they have borrowed money from the bank, not just on a long-term basis, but also on the short term, where they owe the bank £7,500 as well. So that's all for today's lesson. If you want some last minute tutoring to assist you with paper 2 exam preparation, make sure to check the links that are given in the description below. I'll see you in the next video.